All right, hello everyone. Welcome to today's Dynamics 365 Tech Talk. Today's topic is Production Variance Analysis in Dynamics 365 Supply Chain Management. My name is Erin and I'll be your moderator today. We are broadcasting this session through Teams live events and the audio can be heard through your device speakers. This session is being recorded on behalf of the Microsoft Corporation. When you join this event, your name, email address, and/or phone number may be viewable by other session participants in the attendee list. By joining, you are agreeing to this experience. The recording will be available on the Tech Talks Community Dynamics page within 5 business days. If you have questions for the presenters or need support, please use the Q&A panel located on the right side of your screen. Our presenters will be responding to your questions during the presentation with some time for verbal responses at the end of the session. Thank you for your patience during these announcements. Presenting for us today from Microsoft, we have Ann Krupke, Senior Fast Track Solution Architect, and Rachel Profit, Senior Fast Track Solution Architect. Rachel, over to you to kick us off today.
Thanks, Erin, and good morning, good afternoon, good evening, wherever you might be joining us from today. For those of you that are joining us for the first time in our series, welcome. And for those of you who are returning guests, we thank you for your commitment to inventory costing. Let's get started with some quick introductions.
Hi, everybody. My name is Ann Krupke. I'm a Senior Fast Track Solution Architect here at Microsoft on the SCM team. You'll see my contact information here as well as my LinkedIn. Please feel free to connect or give a shout, especially if you want to talk about our mutual love for all things costing in D365.
Thanks, Ann. And my name is Rachel Profit. Again, I am a Senior Fast Track Solution Architect. I'm on the Americas team. And I've got all of my contact information here on the screen. I do invite you to follow me on Twitter, check out my YouTube channel at Dynamics 365 Unboxed, connect with me on LinkedIn, or check out my blog at dynamics365lady.com. Taking a look at our Tech Talk series, this is the 7th Tech Talk in a series of Tech Talks, all focusing in on inventory accounting. In today's session, we're going to be focusing in on production variance analysis. We are working to schedule a fireside chat where we will be answering all of your questions, so keep an eye out for that. We'll be posting about it on social media, so be sure to get registered so that all of your questions that we haven't had time for during the sessions can get answered. We are back again with another riddle of the day. And today's question is, what do you call the head of a furniture factory? We do invite you to put your answers into the Q&A panel, and we'll be revealing the answer at the end of today's presentation. So let's take a quick look at the agenda for today's Tech Talk. We're going to start out by describing the various types of production variances, along with examples and sources. And then we're going to take a look at a case study for the Purple Pillow Company with examples of each type of production variance. We're also going to discuss methods that you can use to analyze your production variances and postings. We'll also take a look at how to use the variance analysis data to react and make updates or corrections to your BOMs, routes, and indirect costs. As usual, we'll always wrap up with our do's and don'ts and some resources that you can use to learn more about production variances. So with that, I'm going to hand it over to Ann to kick us off today.
Thanks, Rachel. We're going to start by talking about the different types of variances that we come across in production in Dynamics 365. When we look at variance in a production environment, we start by summarizing our variances in the same categories that we use to summarize our costs. We have direct materials, direct manufacturing, direct outsourcing, and indirect cost variances. You may recognize these terms as they are also the different cost group types that we have available in the system. One of the reasons many manufacturers choose to use standard cost when it comes to Dynamics is to be able to view variances in much more detail than with other costing methods. Let's review the key differences between our standard cost and other cost methods such as FIFO, LIFO, and weighted average as they relate to variance analysis and production. When you use standard costing, you can select different main accounts for each type of variance to allocate the costs in the general ledger. But when you use any other method of costing, the variances are allocated to the manufacturing cost and are not visible in the ledger specifically. Next, it's important to note that when you use standard costing, the variances for your raw material inputs are not included in the production order. They're instead captured when you purchase the item and posted into your specific account for purchase price variances. However, when you use a different costing model on raw materials, the purchase price variances are reflected in the production order's total cost. Keep in mind that you can have multiple costing methodologies. So if you have finished goods that use a standard cost, for example, but your raw materials use a periodic cost such as FIFO, variances in purchase price will present as price variances in the production order, but will not impact the cost of your finished good inventory. Instead, the cost will be allocated to the variance account that you specify on your posting profile following standard cost policies. When we choose to use standard cost in Dynamics 365, we have an additional method of categorizing production variances, and these are the variance types that drive the postings to the general ledger. The first type of variance is lot size variance. This is caused when the production order quantity is not the same as the standard cost calculation quantity, or in other words, production quantity differs from our standard lot size. The next type of variance is price variance. A price variance is an indication that there's a change in price between our standard cost calculations and our current price at the time of consumption. Thirdly, we have a quantity variance. This comes into play when the quantity used in production is different than what your standard BOM, route, or formula quantity is. This can not only apply to materials, but also to labor consumption. The last type of variance is substitution variance. As the name suggests, this is used when you swap one thing out for another thing. Again, this can refer to materials or resources, for example, in a route. Let's now double-click on the standard cost variance types and what can cause them to occur. For each one, we'll look at how this type of variance is affected by materials, labor, and indirect costs. First, let's look at lot size variances. A lot size variance happens when the constant costs in a cost calculation are allocated differently between our estimated production cost and our standard cost calculation. When you configure an item, you can specify a default or site or specific order setting to define the default quantity that is used for a cost calculation. You can also manually override the quantity when you perform a cost calculation. Constant costs in a BOM can come from the constant scrap field or by selecting the option for constant in the consumption field on the line of the BOM. Setup time in routes is always constant, and indirect costs can be constant if they're related to a cost group for labor or material lines that are constant. When we have a different lot size in our standard cost calculation versus our actual production quantity, our constant costs will be allocated at a different amount per unit, which causes that lot size variance. Next, we have the price variance. For materials, this is controlled by the item price changing. This could happen if there's a difference in the cost between the calculation or even a difference from the time you start the production order to the time you end the production order. The same is true for the labor components if your resource cost changes. And likewise for indirect costs if you update the rate or surcharge in your costing version. The sources for quantity variances can come from a handful of different places in a production order. When we think about materials, this can be when there's a difference in the estimated consumption versus the actual consumption of an item. This can also be the result of reporting an error quantity. Likewise, with labor, the variance can come from differences in the estimated versus actual, which can be recorded in either a route card or a job card. The indirect costs are always dependent on the cost group basis for the material or labor components. And finally, the sources for substitution variances, again, can be different. For materials, the obvious example is when you use a different item altogether, but also adding an item that is not in the standard BOM or omitting an item in the standard BOM can result in a substitution variance. The same general rules apply to labor when you use different, extra, or omit resources or resource groups. And the indirect cost variances will always be related to materials and labor that you estimated versus the consumed. Before we dive into the details of variances with a case study, there's two important parameters that I want to call out. You can find them in the Inventory and Warehouse Management Parameters page on the Inventory Accounting tab, or in the Cost Management module under the Inventory Accounting Policies area by opening Parameters. The first parameter is for the cost breakdown. You can choose between no or subledger. The option for subledger is most commonly selected and indicates that you want the details for material, labor, and indirect costs to post into the subledger. If you select no, they are summarized, which can make them hard to dig into for reporting purposes. The second parameter is for the variances against our standard. You can select summarized or per cost group. If you select summarized, when you look at standard cost production variances, you will only see one line that totals the variances for the entire production order. But when you select per cost group, you can set the details option and see the breakdown of variances for each line in the production order. So now let's look at a case study where we're using standard cost. Here you can see an example of the cost calculation details for our 12-inch round foam Very-Perry pillow. We will use the same item for each one of our examples. So let's start by understanding our standard cost calculation. This cost calculation is based on the default order quantity of 25 for inventory, also known as our lot size. You can see that the BOM has 3 items for fabric, foam stuffing, and thread. The route contains 4 lines in the cost calculation related to our 3 operations for cutting, sewing, and stuffing. In our example, the cutting has both setup and process time, while the sewing time only has a process time, and the stuffing operations uses the quantity output to determine the cost contribution. Finally, the cost calculation shows 3 indirect charges. The first is an output unit-based calculation to absorb machine depreciation. Its absorption basis is the setup time for the cutting operation. The second indirect cost is a surcharge for the internal logistics, which is calculated as a percentage of the total cost. And the third indirect cost is a rate for the indirect labor cost based on process time of the cutting and sewing operations. The first row in the calculation for production shows our total cost for our lot size of 25, which is $464.85. And the unit cost is $18.59 for our standard cost. In our first example in this case study, we will create a lot size variance. You might recall that a lot size variance happens when you have constant costs and the standard cost calculation and production quantity are different. In our last slide, you saw the standard cost calculation was for a quantity of 25. And in our example, we've created a production order with a quantity of 4. No other variables were changed when we produced this production order. After picking, raffing, and ending our production order, we can see the variance in our production variance page. In our example, the variance is shown in the lot size variance column for the setup time on the cutting operation, which is our constant cost. The moral of the story in this case is to ensure that your default order quantity is set correctly when you run standard cost calculations. If your standard cost calculation is consistently different than your production quantity, you will see consistently lot size variances. You may need to consider a different approach to calculating your constant costs, or for example, changing your production process to reduce or eliminate the setup time required each time you run production. In our second scenario, we will look at an example of a price variance. When you use standard cost, this is less likely to happen unless you're frequently updating your standard costs, but with periodic costing methods, this is much more likely. In our example, let's assume that your sewing operation is set to use a cost category called sewing. But for this production order, we need to switch the costing category to advanced sewing, which has higher costs. This might happen in a situation when you don't have an MES in place and your labor is all backflushed at standard, for example. However, you might just want to swap out your whole resource, which would give us a substitution variance, which we'll talk about in more detail later on. So here you can see the route card journal for the production order. We have manually changed the cost category for the category hours to advanced sewing on the sewing operation. After you pick, RAF, and end the production order, you can review the variances. In our example, you can see the variance shows in the price variance column for the process line on the sewing operation. In this case, our variance is $18.75, reflecting the difference in cost category prices from our standard cost and our route card actual cost. So the moral of this story is to consider how you cost resources carefully. Consider if it makes sense to substitute entire resources, and also consider the frequency that you need to switch a costing category, keeping in mind that the warehouse mobile device does not offer a way to switch a cost category out of the box. In our third example for our case study, we've created a quantity variance. For this scenario, we will assume that the standard foam core item is consumed at 25 units per lot size, but we damaged some foam during the production process and instead consumed 29 units of our item. Here you can see a sample of the picking list journal for the production order, where the proposal was 25 units and our actual consumption was recorded at 29 units. Once you've picked, wrapped, and ended that production order, you can view our variances. In this example, you can see two variances are recorded in the quantity variance column. The first is for the additional cost of the 4 quantity of foam inserts that were consumed for a total of $32.64. And the second is for the internal logistics indirect cost, which is calculated as a percentage of our total cost. This indirect cost is configured to be 1.5% of the total cost, and thus the additional variance occurs of 49 cents. If you constantly over or underpick on a particular item on a production order, you should analyze why this is happening and determine the best way to mitigate this. In our last scenario for our case study, we'll look at an example of a substitution variance. Keep in mind this can happen on materials and labor, but for today's example, we've assumed it's a labor variance. In this example, the route for our sewing operation is set to use the 10 sew machine resource group as our operational resource. However, we want in this case to specifically use the SW101 resource. So we create a route card journal and we change the resource ID field on the sewing operation to SW101. Once we pick, wrap, and end the production order, we can see that two variances are created in this example. The quantity variance shows a value of negative $43.75 for the resource group that we did not use in the route. And the positive variance for $43.75 is what we got from substituting that new sewing machine that was used. In this case, we have a wash in terms of the net effect, so the GL posting would be 0 or no posting. If we had switched to a higher cost resource, then that would be reflected in the substitution variance and would result in an overall variance in the general ledger. It's not uncommon that a given production order will have a multitude of variances. So understanding the source of these variances is important, and why we generally recommend to select the option for per cost group in our variances in our standard parameter settings. Substitutions can also cause indirect cost variances if the original item or new item have different indirect costs. In many cases where there are multiple resources that can perform a job, seeing the in and out like this example is a very common occurrence. Now that we have a good understanding of the different types of variances, I'm going to turn it over to Rachel and talk about how we analyze them.
Thanks, Anne. Let's get started with a few different tools. And the first tool we want to discuss for analyzing variances is the Production Variance Inquiry screen. You can access this from a specific production order by clicking the Manage Cost tab and then selecting the Variance button in the Standard Cost group. It's important to note that this button can only be used for an item that is standard cost and has variances after the production order is ended. In this example, you can see that we have selected the details option. When you don't select this option, you'll see one row for each cost group with summarized totals. The net realized quantity and net realized cost columns will show you the actual costs that are posted from your production order. The allowed quantity and allowed cost columns will show you the amounts that have been calculated in the standard cost rollup for the item. The final four columns will show the differences between the net and allowed amounts expressed as the four types of variances for lot size, price, quantity, and substitution variances, respectively. You can also print the details in this screen by clicking the print button in the action pane. The next inquiry screen that we want to look at is another one that you can only use when you have selected a production item for an item that is standard cost. You can access this for one production order by clicking the Standard Cost Transactions button, which is accessed on the Manage Cost tab in the action pane on the production order page. You can also access this page from the Released Product page by clicking Standard Cost Transactions in the Manage Cost tab, or you can view all standard cost transactions by opening the page from the main menu under Cost Management module in the Inventory Accounting Inquiries area. This page shows one row for each transaction. They're typically displayed in their pairs of physical and financial inventory transactions. The values are shown in the quantity contribution and cost contribution that tie out to the amount of the related inventory transactions. If a particular row has a variance, you'll see that amount in the variance column. This next tool is a visual chart that you can access from a production order that's ended. If the production order is not yet ended, the button will be grayed out. You can find the button on the Manage Cost tab in the production order, and you can access this chart for one production order at a time. If you have a need to analyze multiple production orders, we recommend that you start with the Power BI workspace, which we'll review a little more later on. This chart is a great way to see your costs on a production order. You can see a comparison of the total cost on the left chart and the unit cost on the right chart. The chart shows the direct manufacturing, direct materials, and indirect costs stacked on each bar. These values are controlled by the cost groups that you assign to the raw materials and resources on your production order BOM and route. The columns show the active cost for the item, the estimated cost for the production order, and the actual or realized cost for the production order. Variances are then shown in 3 additional columns for planning, production, and total variances on the right of each chart. The next tool I want to talk about in review with you is the Production Posting Inquiry screen. While this screen is not specifically designed to help you analyze production order variances, it is a viewport into the postings that have occurred for production orders. You can think of this as a summarized view into the subledger. The example shown here shows one material consumption, one route consumption, and one report is finished transaction. You'll notice that all of the amounts are in the IIP or inventory in process / WIP or work in process column, as they are the physical updates of the production order. If you post multiple picking lists, RAF journals, route cards, or job cards, there can be many physical costing rows shown for each type. The next row shows the costing, which relates to the ending of the production order and the amounts shown in the cost accounting amount column. And this is the financial transaction of the production order. There will always be just one costing row because once you end a production order, you can't make any additional changes. The last 3 rows show the indirect costs. You will always see at least one line for each indirect cost. But if you post multiple physical transactions, there can also be multiple indirect costs for each indirect cost code in your costing sheet. You can further drill into the details of the transactions by using the buttons at the top of the screen for indirect cost transactions, route transactions, inventory transactions, and vouchers. The buttons will be disabled and enabled depending on the row you have highlighted in the grid. Next, we have the production WIP statement. This is another button that you can access from the Manage Cost tab in the Action pane on a production order. It's important to note that this screen can be used to view any production order, whether standard cost or another costing method, but you can only view one production order at a time in this screen. When you need to analyze multiple production orders, again, we recommend that you use either the cost administration workspace or the production order Power BI reports, which we'll look at here shortly. When you view the production WIP for a standard cost item, you can see the variances row is populated with a value. However, when you access this report for an item that uses any other costing methodology, the variances will always show 0, as the variances are absorbed into the manufactured cost row just above the variances. The screenshot on the left is the data view of the production order, while the screenshot on the right is the chart that's displayed on the bottom of the page when you open the production WIP statement. The next report that we'll look at is the Variance Analysis statement. We took a brief look at this report in part 5 of our TechTalk series, but let's take a look at an example of this report with production data. So let's switch over to the system now. In this demonstration, I'm going to show you how to run the Variance Analysis Statement report. It's found in the Cost Management module underneath Inquiries and Reports, and then Inventory Accounting Analysis or Manufacturing Accounting Analysis reports folders. Both reports open the same option or the same report, so it doesn't matter which one you select. It's also important to note that the variance analysis statement can only be run for items that are costed using the standard costing methodology. Here on the report dialog, I'll select the date interval for the current period. Then in the sorting and grouping option, I'm going to select origin. In this way, I'll see the standard cost variances grouped by the different types of variances such as price variances, quantity variances, and so on. Then in my column headings, I'm going to select to have column headings by the cost group type. For my example, I want to select the option to print the transaction details. This will print the specific purchase order or production order that has caused my variance. Then in the level field, I'll select total. You can optionally filter this report by using the Records to Include tab or run this report in batch. For my example, I'm going to print this report to my screen and click OK. This report may take a few minutes or even up to a few hours to run, depending on the amount of data, the date range that you've selected, and the level of detail. So generally, we recommend that you would run this report in batch mode. Once this report generates to my screen, I'm going to go ahead and zoom in so that we can see the results a little better. Here you can see the first type of variance that is being displayed is a production price variance. It's grouping by the item number, so then I can see all of the various production orders that have a production price variance. You'll see the specific order numbers, the type of transaction, the state that the transaction is in, as well as the variance amount as a total for the item. As you scroll over to the right, you'll notice that all of these materials are showing up in the direct materials column, indicating that the variances are material related. As we scroll down in the report, we can see that the total here is 2825 for the sum of all of the production variances. Continuing to scroll down, we can now see the revaluation. These are a result of changing the standard cost and revaluing the on-hand inventory of my items. You can see that again, it's grouped by item, and at the bottom of the report, you also have a variety of purchase price variances for my items that are using standard costs. You can output this report to Excel or point it to a PDF by using the various options at the top for the export button. And now you've seen a demonstration of how to use the variance analysis statement report. The next report that I want to look at is the cost estimates and costing report. This is another report that's typically run for a single production order at a time, but it can be run for many orders. This is especially useful when you want to analyze the cost for a production order against the estimated cost when you don't use standard costing, but it can be used for a standard cost item as well. You can access the report from the Cost Management module or the Production Control module under the Reporting and Inquiry area. The report here shows the details of the dates and quantities that are used on each production order, as well as each status, such as, or is the current status, such as estimated, started, reported as finished, and ended. The estimation area of the report shows the values from the estimation process of the production order. This is typically the same as the cost calculation for the item, unless you modified the BOM or the route on the production order directly. The costing section on the report shows the actual cost that is consumed in the production order, resulting from picking lists, route and job cards, and report as finished journals. You can run this report before you end the production order as a great way to spot and correct variances before you end the production order, and no additional changes can be made. Now, let's take a look at the Production Performance Analysis Power BI embedded dashboard. The Production Performance Analysis embedded dashboard is a useful set of reports on production KPIs and trends. This report is accessed in the Production Control module under Inquiries and Reports, Production Performance, and then selecting Production Performance Analysis. The page shown in the screenshot here is called Production Variances for Job Order Costing, and you select that by selecting the last tab on the bottom of the report. On the top left, we can see the variances posted on different points in time and the breakdown across materials, labor, and indirect cost variances. On the top right, we see a list of the top 10 products with unfavorable variance, and in our case, we only have 2 currently since we're working with demo data. On the bottom right, we can compare variances across different sites, and again, breaking the variance into materials, labor, and indirect costs. On the bottom right, we are shown the top 10 resources with unfavorable variances. It's important to remember from a cost perspective, resources can refer to items, production resources like machines, tools, and workers, and indirect cost codes. In our example here, a production resource have the top 3 highest unfavorable variances, but the next 3 are materials, and the final one is an indirect cost. Now I'll hand it back over to Anne to talk a little bit about how we can react to and correct variances.
Thanks, Rachel. Let's dive into it. Before we can take action to correct our variances, it's important to understand the sources of variance in the production process. When you understand the source or the cause of the problem, you can more easily address the issue in your production process and setup and configuration in the system. The first cause of our variance, it could be a problem with our data. When you have consistent variances on a specific item, this is a typical indication that there's a problem in your data. This could be, for an example, an item that has a consistent $30 variance or even a smaller variance every time you produce that item. You might notice that you consistently consume more than your proposed material quantity or frequently use a different machine to produce your item. When you see large variances either up or down that are not consistent, this can be an indication of a problem with your production process. Process issues can be related to training issues with your staff, a machine that requires maintenance or replacing, or even the quality of the products that you're receiving from your suppliers, just as a few examples. And finally, it's important to recognize that sometimes variance is just the result of chaos or randomness and is not something we can always use data or process improvements to get rid of. Some degree of variance is normal in a business, and that's okay, as long as our numbers make sense, and of course, we can explain them to our auditors. When you consistently find variances in your production that are related to materials, you may need to make adjustments to your setup and configuration to ensure that future orders have a reduced variance. For example, you may need to conduct a material study. Let's say you've noticed a large amount of stuffing is being consumed on certain production runs for pillows. You might go watch the warehouse workers that are stuffing the pillows with the foam or cutting the foam to see how the process is done. You might find that you can retrain workers to reduce scrap, but if you find that scrap is consistently higher, you'll need to adjust the scrap factors in your BOM. Keep in mind that it may not be obvious from your production variance analysis reporting that there is an issue if your items are automatically consumed as part of your production process. In this case, you would want to look for items that have consistently high cycle counting variances or abnormal cycle counts for a particular item. When you identify that there's an issue in the BOM, one of the most typical ways to solve the problem is to create a new BOM version. Depending on the cause of the issue, you might adjust the actual consumption quantity or setup scrap consumption, for example. In the case of scrap, you can adjust the constant or variable scrap factors in a BOM. Another option is to update the production BOM directly. While this will correct the individual production order, the new values will not be used on new production orders. So if your anomaly was one time due to extenuating circumstances, this is a good option. Anytime you create a new BOM version, it's important to make sure you run a new cost calculation if you're using standard cost. But keep in mind that you could be getting price variances because the subcomponents or raw materials of your production order have changed over time. If you do not have a process to regularly run new cost calculations, expect that you might see variances in your materials and labor costs. Just as material variances can be a cause of your overall variance issues, your labor variances can be a problem in your production process, and you may need to adjust your labor components to reflect new information to reduce your variances. Just as your cost accountant might do a material study, you might need to perform some time studies. Time studies can be done the good old-fashioned way with a stopwatch, notepad, and lots of patience on your production floor. In a more modern warehouse, you may be able to use data from your MES to deduce where the issues are, or you might even be able to put IoT devices in key processes in your warehouse to more accurately capture the data about your machines, people, and so on. With your labor components, the strategy for updating your routes is similar to BOMs. You can directly update the production route, which will only affect one order, or you can create a new route version. The same principles apply here as with updating BOM versions. However, with routes, keep in mind that you have 3 calculation methods that can be adjusted to capture the correct values that affect the cost of production. If you need to add constant time to your route, look to use the setup time. When the cost is variable, you'll either look at runtime or quantity. You may need to analyze your run size as well to see how running 10 versus 100 or even 1,000 units might affect the total time it takes to make your product. Cost calculations are just as important for route changes as they are for BOM changes. While your labor rates or cost category rates are not likely changing at the same pace your products are, make sure you have a clear process defined for updating the rates and then running cost calculations on your items. The last point to consider is how you will manage exceptions. Not every variance in labor indicates that you need to fix or change your data. Consider if other mechanisms should be put in place, such as training, quality control, and so on. Reconciling and adjusting indirect costs can be a more complex process, but in this process, it's just as necessary when you're trying to get an accurate cost for your production. Although production variance analysis reports will show variances in indirect costs, to really know if you need to make adjustments to your indirect costs, it's a slightly different approach from labor and materials. You will need to start by cataloging or listing the costs that contribute to your production costs indirectly. These costs are typically expenses tracked in your P&L. To take a simple example, let's use rent. You likely have a GL account that represents rent expenses. The rent cost might be broken down by physical site or you might summarize them. In reconciliation, it's likely easier to break the cost down to site or warehouse, or maybe even department, depending on the structure of your warehouse. Next, you will need to decide how the cost of the rent will be allocated to your production costs. For example, you might allocate the cost to your production based on the quantity produced, or the volume produced, or even the revenue associated with each item. Once you have your GL costs and production attributes, you are likely to reconcile the allocation principle against your production data, and then divide the total rent by the quantity produced, for example. That is the amount you'll allocate to each production order by configuring an indirect cost in the costing sheet. Keep in mind that there are a variety of methods for calculating an indirect cost, including a surcharge, which is a percentage, rate, which is a flat amount per unit, and along with input and output unit-based calculations. You can also have different rates per site, item, or groups of items, depending on the type of indirect cost you're using. Remember that you'll need to periodically reconcile your production attributes against the GL costs to ensure that the amount you're adding up lines up with what's actually being incurred from a cost perspective. For example, if you increase production rates or run longer shifts, your production indirect cost absorption may not align with the expenses in your general ledger. Likewise, if your rent increases or you give your workers a raise, for example, those costs will not automatically find their way into production costs. With that, I'm going to hand it over to Rachel to wrap us up.
Thanks, Anne. Let's take a look at our resources and recommendations, and we'll start with do's and don'ts like usual. So taking a look at our do's, it's really important to make sure that you end your production orders to establish a final cost. If you don't end your production orders, you won't have a financial cost recorded on those transactions, and any variances may not be recognized in your ledger. It's also important that you understand the differences in variance reporting for standard costing versus other methodologies. So today we looked at a variety of reports that can be used specifically for standard cost versus reports that you can use with any item. Making sure that in your project you define the reports that are needed for your purposes, for reconciliation, and for analysis to determine how you will react to those variances. It's also important to remember that you're going to need to review your BOM and route data periodically to analyze the accuracy. That also applies to your indirect costs in your costing sheet as well. You'll also want to make sure that you schedule a refresh to update the production entity store data when you're using the Power BI embedded reports. That data is not coming from regular tables in the system that are real-time. It's instead coming from an entity, an aggregate entity. So you'll need to update that entity on a regular basis. Some things to make sure that you don't do. Don't forget to set default costs for your non-standard cost items. That default cost is used in the cost rollup and can make sure that your rolled up costs in a standard cost item, especially if you're using mixed costing modes, are accurate. Another don't on our list is don't forget to set your default order quantities appropriately if you have fixed costs. So that default or site-specific order setting is set directly on the released product. If you leave that blank, then every time you run a BOM calculation, we would be having to specify that quantity manually, and that can be a lot of work, especially if you're mass running calculations for lots of items. And also, the last don't on our list is don't end your production orders until you've finalized the postings and made any corrections. Keeping in mind that once you end a production order, you can no longer make any updates to that production order. So for that reason, it's always a good idea to look at the potential variances on that production order and make any corrections before you go through that ending process. We've pulled together a variety of additional resources for you. We do have the link to the blog where you can see all of the details about inventory accounting setup from this Tech Talk series. We do invite you to check out the docs on the cost management homepage. There's also a few additional pages that are very specific to production variance analysis that you might want to check out. The first one is the production order cost analysis and the common sources of production variances pages in the docs. We do invite you to connect with the product team on the Yammer group as a great way to ask questions and hear what's new and coming up. And if you've got ideas for the product, we do encourage you to submit those out on the ideas page. That brings us back to our joke or our riddle of the day. What do you call the head of the furniture factory?
I don't know, Rachel. What do you call the head of a furniture factory?
The chairman. We did have a few people that guessed it correctly, so thank you for playing along with us. We know that they're a little cheesy, but we enjoy them. We think they're kind of fun, a little way to kind of change it up a little bit and kind of keep it light on such, deep topics. And with that brings us to the Q&A portion of our session. And I do see that we've got quite a few questions in the chat. So if you've got questions, feel free to keep submitting those into the Q&A panel, and we will try to get to those. If we don't get to them today, we will try very hard to get to them in our fireside chat. And keep an eye out for some social announcements about the date for our fireside chat where we'll answer additional questions. Anne, do you want to take us through the questions?
All right, let's get started. We've got some really good questions today. Our first question is, in the production order end process, can I allocate the scrap cost on a specific account if I'm using the weighted average costing method?
That is a great question, and I don't know the answer off the top of my head. Anne, do you know? Obviously, I know that there is an option in the production control parameters where you can specify a scrap account. I think my assumption is that it works no matter what costing methodology that you're using. And so it depends on the option you choose in those production control parameters. There's two options, one that's like allocate to the item and one that's to a scrap account. And if you choose the option for scrap account, there's another field where you then specify the main account. I do believe that it works for all costing methodologies, but I would have to test and verify.
That's my understanding as well, that it works for all costing methodologies. And that parameter is available in production control parameters on the standard update tab. It's called scrap method. Your options are allocation and scrap account. When you select scrap account, the scrap account field is enabled, and you can select the specific main account that you want to post to for that. Okay, this is another good question. What would you recommend to customers who want to include a different overhead cost rate to every product? Rachel, you want to start on this one?
Sure. So you can set up indirect cost rates or surcharges to specific products. Not every allocation method allows the item option. Obviously, if you are going to do this, you need to make sure that you've got a good reconciliation process and a good kind of updating process in place, keeping in mind that it's likely a lot of maintenance to maintain that many indirect cost codes. Another option, if your indirect costs don't need to necessarily go into their own general ledger account and aren't on the basis of another product that's going into the production, is you could consider using the price charges to add in just additional cost into the standard cost, but that will just roll into the item cost, not be posted into a separate GL account. So I think there's kind of two choices there that you really have. While it's certainly feasible, you're going to want to definitely think about the long-term maintenance of that data.
Yeah, I agree with that. I would ask, why is it so important that it's tracked per item, and is it really even possible to understand a different rate for different items in the production environment.
Yeah, and oftentimes, like I would guess, like if this is a scenario that you're facing, most likely like the types of costs that they're trying to add, if they really aren't actually overheads, it might be that we need to put them into the route costs, like the resource costs, and add more operations that can even be backflushed and automatically consumed, or even item costs that can be automatically consumed. So, you know, I wouldn't suggest that you use an indirect cost as a substitution for creating a proper route, which is something I've seen in the past.
That's a good call out, Rachel. Okay, coming back to our scrap allocation method, I think it's a good to point out that based on the comments, it seems that that does not work for standard cost. The question was asking for weighted average. So I do think it seems like it does work for that, but it may not work for standard cost to allocate scrap to a specific scrap account. So Rachel, I think that's a really good one for us to kind of test all the scenarios and come back with a blog post or video on how that parameter works.
Absolutely.
Another good question. Can we see the detailed production variance in the production order if we're not using standard cost? And I can take this one. The answer is no. The screenshot we showed, maybe Rachel, you want to pull it up again. The production variance form is specific to items using standard cost. If this is something that, so here we see it, the lot size variance, price variance, quantity variance, and substitution variance are specific to standard cost items. This menu item on production orders is grayed out when you use non-standard cost to produce your items. So if this is something that you require, we definitely recommend that you create an idea or search the ideas site to see if there is one already, and we can see what kind of feedback we get there and bring it to the product team's attention that this is a requirement. But this is one of the reasons why many manufacturers choose to use standard cost, because it gives them this extra level of detail. The next question is, are there any way to allocate back the production variance into inventory every month end? Rachel?
So I guess the qualifying question is, like, I'm not sure if you're talking about like production variances from standard cost or production variances from a different costing methodology. If we're talking about standard costing, right, those variances are getting posted into specific GL accounts that you specify in your recognized in inventory. You can certainly point them to an inventory account rather than a P&L account, which is where if you want to post them into P&L and kind of reabsorb them back into inventory, you can certainly do that through a manual journal entry or using like an allocation rule in the general ledger. Should not post them directly into your system inventory account, because then you won't be able to reconcile your inventory subledger to the ledger. So you still need a secondary account in your balance sheet to do that. If you're talking about like a period, FIFO, LIFO, etc., variances are recognized back into the inventory when you run the inventory close. So hopefully that answers the question. If not, feel free to kind of add some clarifying comments or another question into the Q&A panel, and we'll try to get that answered.
Thanks, Rachel. Our next question is there a way to carry variances to the parent order or project rather than the general ledger? So I think this is another one where if you're not using standard cost, the variance will follow your product all the way through. So if we had, for example, in these scenarios that we covered with variance, if we had used FIFO instead of standard cost, then the cost of our product that we made would include the positive or negative variance in that unit cost. And then when we issue it on a sales order or to a project, the cost of that issue would be valued based on the cost model, right? Like FIFO, LIFO, weighted average, but it would include that variance as part of a factor. Rachel, you want to?
Certainly. Yeah, and I think if you need it to be exact, right, that's where I would look to use batch or serial number control, so that the subcomponent batch number is the exact batch number that you're consuming in the parent order. If you do need it to be exact, and then use like a costing methodology. It doesn't really matter if it's FIFO, LIFO, or weighted average. You could also look to use marking, right, if you need it to be actual and exact, but that only works with periodic costing models, not with standard cost.
Yep. Another question, is this also valid for Kanban orders? That's a really good question. Kanbans work differently than discrete and process manufacturing. They do something called backflush costing, where you issue everything to your production flow, which is like a shared BOM and route across many different items that are produced in the same kind of like production line. And then you periodically backflush the cost for that whole thing, and then it applies across items, which is a very simple way to explain it. This is one of our options for a follow-up topic. There's a link to backflush costing that I'll put in the chat in just a minute that explains how that works. But we are considering doing an additional deep dive session on how lean manufacturing accounting works in Dynamics. Anything to add there, Rachel?
No.
Okay.
You said it well, Anne.
Is there any capability to analyze such regular variances automatically per item and highlight them as recommendations for review? Something with machine learning functionality maybe, or do we need to review every item manually? That's a good question. Rachel?
Yeah, I mean, we don't have anything out of the box, but you know, with that sort of mechanism, but there's no reason why you couldn't kind of use AI builder in the Dataverse. So like enable the, depending on if you're standard cost or FIFO, either InventTrans or standard cost transactions into the Dataverse, and then use like AI builder or even more advanced things like Azure machine learning to do that. It would certainly be a customization at this point, but it's an excellent idea, and you should certainly put that out in the ideas site if it's not already out there, and vote it up.
Okay. Let's see. Our next question is, can you please identify or summarize the standard reports or inquiries available to view production variances working with weighted average cost method? I think the easiest way, Rachel, maybe is to talk about which ones only work with standard, and then the rest of them work with all of the cost methods, right?
Yeah, so the first two that I discussed, production variances, is standard cost only and standard cost transactions. The remainder of the ones that I covered, cost comparison, production posting, production WIP statement, cost estimates and costing, and production performance analysis, are all costing methodology agnostic. The variance analysis statement, which I also did like the demonstration of, is also standard cost only. So 3, I guess, are standard cost only, and the rest can work with weighted average.
Great. Our next question is, what is the effect of the scrap field in the route per journal on the production order? I can take this one.
Sure.
It's just an extra way to recognize consumption of your route. Sometimes companies want to differentiate between you know, like value add time, which would be the process time or setup time, and then scrap time, which is considered, you know, maybe non-value add. And then when you're using that scrap allocation parameter, it can allow you to post it separately. Rachel, anything to add to that?
No, I think that's a good explanation.
Okay.
This looks like a duplicate.
Yep. Someone said that, so the question about allocating production variance back into inventory was specific to standard cost. So I think you already kind of answered that one though. Our last question I think we have time for is for discrete production, which costing method would you use? And I think that always comes back to it depends. We did a tech talk on all the different available costing methods in this series. So if you go to our recordings page, it's number 2, covers everything except for standard. And then we did an entire tech talk on standard, which is number 3 in the series. So if you want to understand kind of the differences between the cost models and why you might pick one versus the other, I think that's a really good place to start. I would say, in my experience, standard cost is very, very popular. As long as you know that your standards have a good degree of accuracy, I think that's the kind of caveat there. We also see oftentimes that manufacturers use standard cost for finished goods, but maybe their materials use weighted average or FIFO. But again, it comes back to what are your requirements and how accurate is your base data if you are calculating standards.
And also keep in mind that not every country or region supports all of the costing methodologies. So like your specific customers, like even like the legal entity, like if you're a global company, you might have to use one costing methodology in one country and region and a different costing methodology in a different country or region to be compliant with the local regulations, just to add to that. So there is no one size fits all answer to that question. You really need to understand the customer requirements, regulatory rules, and so on before you select a costing methodology. But to Anne's point, check out parts 2 and 3 in our series, and that will help give you all the things to consider when selecting a costing methodology.
All right.
I think that's all the time that we have for today's Q&A portion. So I'm going to hand it back over to Erin to wrap it up today.
All right. Thank you, Anne and Rachel. I'm going to post a link to a short survey in the Q&A panel. If you've already taken that, I posted it earlier. Thank you so much. So that is now there. We'd love to get your feedback on today's session and to hear what you'd like to see in future events. Thank you so much again for your participation in taking that survey. As a reminder, the recording of today's session will be available on the Tech Talks Community Dynamics page within 5 business days. I'd like to extend a big thank you to Anne and Rachel, and of course to the audience for joining us. We hope you have a wonderful rest of your day, wherever you may be.